Hi, I'm Hayden Gaus at Beacon Light Wealth Management. Today we're talking about step-up in basis, one of the most valuable tax rules many families have never heard of. We're going to break down what a step-up in basis is, how it generally works for spouses and non-spouses, and some common planning situations where it becomes an important consideration. Let's get started. So let's start with the basics. When you purchase an investment like a stock, mutual fund, ETF, or even real estate, your cost basis is generally what you paid for it, plus certain adjustments over time. So for example, let's say you purchased a stock for $100,000. Over the next 20 years, it grows to $500,000. If you sold it during your lifetime, you could generally owe capital gains tax on the appreciation, depending on your individual tax situation. But what happens if you never sell it and instead leave it to your heirs? In many cases, certain appreciated assets included in a person's taxable estate may receive a new cost basis equal to the fair market value on the date of death, or another valuation date if properly elected by the estate. Using our example, instead of inheriting stock with a $100,000 basis, your beneficiary may inherit it with a basis of approximately $500,000. If they sold the investment shortly after inheriting it for about the same value, there may be little or no taxable capital gain because of that new basis. Now let's talk about spouses because the rules become a little bit more nuanced. In some states, often called common law property states, only the deceased spouse's ownership interest generally receives a step-up in basis at the first death. So for example, if a married couple jointly owns an appreciated investment, only the deceased spouse's portion generally receives a new basis at that time. However, community property states may offer a different result. If the property qualifies as community property and the applicable requirements are met, both the deceased spouse's interest and the surviving spouse's interest may receive a step-up in basis when the first spouse dies. That can significantly reduce future capital gains if the surviving spouse later sells the asset. The rules can vary depending on state law, how property is titled, and each family's individual circumstances. What about someone inheriting assets who isn't a spouse? In many cases, inherited taxable assets passed to children, grandchildren, or other family members, or even unrelated beneficiaries may also receive a step-up in basis, depending on the type of assets and applicable tax rules. The relationship between beneficiary and the person who passed away generally isn't what determines whether the basis adjustment applies. Instead, it's largely determined by the type of asset and the applicable tax rules. It's also important to know that not every asset receives a step-up in basis. Traditional IRAs, 401ks, and most tax-deferred retirement accounts do not receive a step-up in basis in the same manner as taxable brokerage accounts. Instead, beneficiaries typically inherit those accounts subject to their own set of income tax rules. So when does all of this become important? Here are a few common planning situations where step-up in basis often becomes part of the conversation. First, for some individuals, one consideration may be whether to sell a highly appreciated asset during their lifetime or retain it as part of an overall estate plan. Taxes are just one factor among many, but understanding the potential impact of a future step-up in basis can help inform that decision. Second, it's important to understand the difference between gifting an asset during your lifetime versus leaving it to someone through your estate. In many cases, a lifetime gift carries over the original owner's cost basis to the recipient. By contrast, inherited assets may receive a new basis at death if the applicable requirements are met. That difference can have a meaningful impact on future capital gains taxes and is one of the reasons gifting decisions are often coordinated with an overall estate plan. Finally, step-up in basis is often considered alongside broader estate planning strategies, charitable giving, trust planning, and decisions about which asset may be more tax efficient to spend during life versus leaving it for beneficiaries. The key takeaway is this: step-up in basis can be a valuable tax rule, but whether it applies depends on the type of asset, the ownership structure, state law, and your individual circumstances. Thanks for watching, and I'll see you in the next video.